Mayuresh Joshi, who joins us to help us out with some fundamental analysis. Hi Mayuresh, good afternoon. Mayuresh, I want to ask you about the cement space because there were two big brokerage notes that came in earlier today. So I'm going to just run our viewers through that and then I want to know your view, how you want to approach the space. Now, the two big brokerage notes on cement that came out earlier today, and both of them have contradictory views. Nomura, well, they're positive, while UBS is cautious. Let's start with Nomura first. They believe that we are in a strong near-term up move and the drivers which outweigh the structural challenges. So they say the positives outweigh the negatives. They have observed that in the past 4 election cycles, the industry records its highest volume growth in the pre-election years. And they have forecasted that cement demand over the next 2 years, that's FY24 to FY26, well, it will grow by around 5%. That compares with around 3.8% that it's grown in the last 10 years or so. They remain positive in the near term due to the moderated input costs. And they're expecting the EBITDA per ton to improve by 30% on a year-on-year basis in the coming fiscal, though they admit there's limited ROCE expansion potential due to the large underutilized asset base and also the flattish cost structure. Their top pick is Dalmia Bharat, as they believe that there is potential to become a pan-India player in the near term, while they have a reduced rating on Shree Cement, as they are losing the cost advantage that they had and also they're moving away from their core market, which was North India. Now, moving to the cautious view then, UBS, well, they are cautious on the cement space. They have a contrarian negative view. That's because of the rising competition as well as expensive valuations. They say that any sharp uptick in the stock prices is a good opportunity to book some profits. The key reasons that they have highlighted is that demand is likely to slow after the general elections, that's post-2024. Capacity addition is likely to exceed the medium-term demand. They also expect players to resort to pricing to grow or defend their turf. And they also see limited room for value accretive M&A. They're positive though on ACC. They retain a buy call out there. They've tapered down their target price on that one, while on other names, they've cut their ratings and they have a contradictory to Nomura. They have a sell call on Dalmia, which Nomura is most positive on. Mayuresh, what are you making of the cement pack? Two views coming in there. After a while, actually, I have a negative view coming in from a brokerage, from UBS on cement, because everyone's saying cement's going to grow. India needs cement, whether it's infrastructure, real estate, it's a good way to play. Do you agree, or would you be a little bit cautious after the recent run?
Afternoon, Nigel. So I think from a structural perspective, obviously, I think cement is a very good space to be in because all the macros that we are speaking about, and you just spoke about, government capex, private capex coming through, expectations in terms of more investments happening both in the real estate, stroke infrastructure, stroke construction sector, will prop up demand for cement over the next few quarters and years. Having said that, the recent corrections that you see in input costs, specifically petcoke prices, have come off significantly. That's going to be a huge accretion in terms of the EBITDA per ton, because you're going to see a straight addition in terms of cost savings from this aspect. The other element in terms of crude prices being low, freight costs are expected to also play out very, very positively for cement companies on a year-on-year basis as well. The third aspect in terms of the WHRS plants and the captive power plants that they're probably using, even power costs are expected to have a significant reduction on their balance sheets. And therefore, I think input cost reduction is a big positive. When it comes to the overall volume growth for the sector as a whole, Nigel, our own expectation over the next few years is that capacities, even if they start building up, both in terms of clinking and grinding units being put through, demand will also catch up significantly, and therefore utilization levels should exceed 75%, creating a natural operating leverage onto balance sheets, and therefore reported EBIT and reported EBITDA per ton should be relatively better. Last 2 quarters, just to put in perspective, a lot of volumes have been pushed through at the dealer level, and therefore inventory buildup has been very, very obvious. Q2 is obviously expected to be muted for monsoons, but second half can be equally strong in terms of execution. So we remain selective because a few stocks on our own lens, where the EPSRS ratings look extremely strong with good institution holding and expectations of these cases playing out, will be Ultratech cement. So valuations can always be an argument against it, and Dalmia.
Mayuresh, do stay on. We need to get into a break. We'll come back and we'll be closer to market closing also.
The Women's Collect.
Back in conversation with Mayuresh Joshi, Head of Equity Research at William O'Neill. Mayuresh, what's happening with BSE? Big volumes, sharp surge in the stock price. Anything that you've picked up?
Riva, I'm so sorry. Could you repeat the stock name, please?
BSE, Bombay Stock Exchange.
Okay. So again, I think normal, activity in terms of demat accounts being added. I think darling in terms of the COVID fall and the recovery thereof. Not specifically heard anything in relation to what is particularly happening. But I think the kind of business model that they've probably got in terms of trading action and transaction value probably remaining stable. Annuity incomes are probably expected to remain stable as well. And therefore, the cash that they probably have in the balance sheet creates a further accretion onto the overall reported earnings as well. But nothing specific that probably have.
All right, Mayuresh, very quickly before we let you go, HCL Tech and TCS, they come out with their numbers in the next 120 minutes. What's your view on them? If the numbers are weak, will you look to buy into any of them?
No, I think we'll still wait it out, Nigel. I think two things. One, I think for the sector as a whole, specifically the large caps, I think the expectations are very, very muted, which is a very good sign. Because if they deliver as per market expectations and the under delivery is not too significantly worse off than what the market was probably believing, my sense is that there might be just a knee-jerk reaction on these stocks and they might then consolidate, looking at what the management commentary is all about. But a large part of the expectations in terms of muted revenue growth for TCS in particular, the added EBIT margin pressures because of wage payouts, and commentary in particular, looking at how BFSI retail manufacturing will actually play out, is going to be extremely critical. On top of that, how the utilization levels probably play out for the sector as a whole is going to be extremely, extremely critical. So everything hinges probably in terms of management commentary at this stage. And secondly, I think if the numbers are not too worse off than what the market is probably believing, I think the markets will take that into account.
Okay, all right, Mayuresh, thanks so much for stopping by and giving us your view on those stocks.